One of the things I think our industry has done a poor job of is helping clients properly structure their portfolios. In this competitive, short-term focused world, too often we see advisors turning into order takers rather than financial experts. During the late stages of this stock market bubble, we've seen both types of advisors. We've seen those that are order takers have unhappy clients that are leaving to find higher returns. The ones that actually take the time to set up a proper portfolio for the client and have put themselves out there as experts are not only retaining nearly all of their clients, they are adding new clients, which is likely from advisors that were just order takers. The CFA materials spend a great deal of time talking about portfolio construction. Here's a simple 4-step process to turn from an order taker to a trusted advisor. The media has not done us any favors in helping clients find their real benchmark. Too many measure their performance against the S&P 500, even though that is a narrowly focused market index. With the use of a financial calculator, spreadsheets, or financial planning software, we can help clients determine the most critical step, which is the first one they need in their portfolio planning process. That is the required return. This is the number that they need to earn. This makes performing financial reviews rather simple. Once you know this required return, the S&P 500 performance or other popular benchmark becomes irrelevant. The focus needs to be on this number and only this number. I've seen so many conversations turn quickly when a client says, but the S&P 500 made 15% last year, and I only made 5%. The advisor then simply replies, yes, but you only need 4%, and you can afford to take the risks necessary to get that 15%. So what goes into that? It's simply the return needed to maintain or achieve the primary goals of the portfolio. You look at the income needs, and you look at the growth needed to reach that target level for retirement. And again, once you have that number, everything else pretty much becomes irrelevant. Now let's talk a little bit about risk. That's step number 2, which is determining the real risk tolerance. This is another area where I see our industry fail most of the time. Too often advisors focus on the willingness to take risk, which is essentially asking, how do you feel about risk right now? What we've seen over and over again is the attitude towards risk for most clients tracks the direction of the market. The more the market goes up, the more accepting of risk. The more that it goes down, the less risk somebody is willing to take. There are now several pieces of software available that assess the overall attitudes towards risk, but I've seen those tilted based on market direction as well. In other words, people that 5 years ago used that same software were basically pessimistic on the market. They showed they didn't have much willingness. Now they take that same assessment and all of a sudden they have a higher willingness to take risks. So we need to really be careful with that. What we really need to be asking as advisors is how much risk are clients able to take? This is not an emotional exercise and is based on objective data. The longer the time horizon, the more stable the sources of income, the greater the size of the portfolio, the smaller the income demands of the portfolio, the lower the liquidity needs, and the greater the size of the assets, the higher the risk tolerance. The inverse is also true. Too often I see clients that have a low ability to take risk invested in risky portfolios simply because they said they were willing to take on more risk. There's a simple rule here. The client's ability to take risk should always supersede the willingness to take risk. If a client has a high ability to take risk but simply is unable, we can educate them on the advantages of taking on more risk, which means they have higher potential returns. Conversely, if a client has little ability to take risk, it shouldn't matter how much risk they want to take. We cannot, as fiduciaries, allow them to take on that risk. Remember, we're the advisors, not the order takers. We need to advise them that it's not in their best interest if they don't have that ability. Now let's move to step 3, which is determining a desired return. This is, of course, different than the required return, which we already calculate, as well as the risk tolerance. Oftentimes, there's other goals. I call this the aspirational benchmark. The required return is that number that they need to take care of primary needs, the living expenses throughout retirement. We call this one the desired return because that's what's needed to get to those secondary goals. Notice these returns are not necessary to cover these primary goals, such as living expenses, but rather the things they would like to do with their money. I look at it as the got to have versus the nice to have. The required return's the got to have. This desired return is, oh, well, it would be nice to do these other things. This is where oftentimes it makes sense to separate the accounts into two baskets, one for the primary goals and the others for the secondary goals. That way they don't become intermingled. It's one of those behavioral finance things I mentioned in the prior update, where you want to take care of the behavioral side. You want them to have their core money invested in some place that they understand is that required area. And then the aspirational bucket, that desired return, can be invested elsewhere. Dynamic Aggressive Growth is a program nicely suited for these secondary goals. Now, step 4 becomes critical, where you need to reconcile the return and the risk objectives. This is really the hardest part. It's not always easy to sit across the table and say, look, your return goals don't match up with your risk tolerance. If a client needs or desires a 10% return and they only have a 10% risk tolerance, guess what? We have to tell them no. That's our job as advisors, is to be that adult. It's not fun. It's not always a calm conversation, but it must be done. It is at this point where we need to help them determine ways to revise their goals by changing their financial situation and or their goals. They might need to modify some of those secondary goals or those tertiary goals, some of those aspirational things we just talked about. They might need to accept a higher level of risk if the ability to take risk is there. They might need to move back the date of their retirement, or maybe reduce the standard of living during the retirement. They could also increase the current savings, which means they lower their standard of living during the working years. Again, this is not fun. I mean, anybody that has kids knows it's much more fun over the short term to just always say yes to your kids. But then they end up not having a good sense of value, a good sense of what they should eat, what they should do, what they shouldn't do. Our job as advisors is to be that valued expert. We have to sometimes tell our clients no, tell them why we're telling them no, and then move on from there. This is, again, another situation where splitting the portfolio into segments may help you create one to cover the required returns. We call that the core bucket. And then the desired return is placed in a surplus portfolio. And that's where, I've seen a lot of people. Sometimes, we hear Susie Orman, oh, annuities are bad. And then we have our clients say, I don't want an annuity. Sometimes, if their return and risk differences don't add up, we have to do that. Strategic Equity doesn't offer annuities, but we understand the value of annuities. We see, honestly, one of our best producing advisors that we see being the adult, that valued expert, uses annuities almost with every case because that provides them that that core money. So then we can focus on managing the surplus money to provide the longer term portfolio. Once we know the risk tolerance and the return targets, selecting a portfolio becomes as easy as gathering all the data and plotting it on a return to risk chart. It's not always easy. We talked about in the prior update about the ways that you can look at that. But it's critical to understand we are structuring a portfolio for the future, and the past may not repeat, especially in our current economic situation where we have structural issues we must deal with. This makes it more important to use a scientific approach to asset allocation. As we mentioned earlier, The current 10-year optimization is probably more characteristic of how the market will be over the very long term. But based on your own market outlook or that of the clients, you may want to utilize a 15-year chart or something different. It's important to keep in mind, again, we're talking about future returns, so we need to find the thing that best matches what we think the future is going to look at. Both charts have significantly lower returns than what most people are expecting over the long run. That's important to understand. Most people are still plotting to believe they're going to get 10% from the market. They're going to get 5 or 6% from bonds, when that may not be the case. One important thing to note when selecting the portfolio is you may want to start at the risk level. Not may, you do want to start at the risk level and follow the line up to the most efficient, which is the highest returning portfolio. For instance, looking at this chart here, if somebody has a 15% downside risk tolerance, you follow that up and you can end up with a dynamic conservative growth portfolio, which is 30% dynamic aggressive, 70% of our bond encore. Or if they're 20, you follow that up and that's the dynamic moderate growth. Most clients end up plotting somewhere between the 10 to 20% risk tolerance level. So those that are around the 10%, we have the option to go the bond encore or maybe just tactical bond. Now there's risk of being in just tactical bond, which is why we push people a little bit more towards our bond encore. Those people with that low of a risk tolerance really don't have a way to get into dynamic aggressive growth unless, going back to those prior steps, we're able to split the portfolios up into that core and the surplus bucket. Too many times I hear people say, well, I need 8%, therefore I guess I have to accept the 32% downside risk of DAG. So they look at the chart and say, well, where's 8%? Okay, well, I guess I'll do 30% in DAG. Now, granted, that's a little bit better than the Morningstar Aggressive, which is only giving you about 7.6%, I believe it was, and 41% risk. But still, you have to then take a step back, go back to step 4, and once again reevaluate everything they have in their plan. It's all about being that adult in the conversation, that valued expert. You need to make that switch from being an order taker that says, oh, you want 8%? Let me give you 8%, to let me tell you why you can't afford to take 8%, and let's figure out a way that you can reevaluate your portfolio. If you'd like more information on how you can utilize SEM's new dynamic portfolios, I'd encourage you to contact your SEM relationship manager or go to www.stratequity.com.